one decision, one investment, one financial breakthrough. The stock market. Intimidating for some, but a goldmine for others. If you've been thinking about diving into the world of investing, but don't know where to start, you're not alone. The good news: you don't have to be a financial expert to begin your journey. So watch the full video and you'll have a clear roadmap to start building wealth through stocks. But before we start, make sure to hit that thumbs up and subscribe to our channel, so you never miss out on more essential investing tips. Let's start from understand the basics of the stock market. What is the stock market, and why should you invest in it? Before you start investing, it's important to understand what the stock market is and how it works. The stock market is a marketplace where investors buy and sell shares of publicly traded companies. When you invest in the stock market, you are essentially buying a piece of a company. The stock market offers opportunities for growth, but it also comes with risks. Understanding how it works is essential for making informed decisions that align with your financial goals. Set clear financial goals. What's your ultimate goal for investing in the stock market? Setting clear financial goals is the first step toward becoming a successful investor. Are you saving for retirement, a down payment on a home, or building wealth for the future? Defining your goals will help you determine your investment strategy, time horizon, and risk tolerance. Clear goals also give you a sense of purpose and direction, which can help you stay committed to your investment plan over time. Assess your financial situation. Can you afford to start investing without jeopardizing your financial stability? Before diving into the stock market, it's crucial to assess your current financial situation. Take stock of your income, expenses, debts, and savings. Ensure you have an emergency fund in place, ideally covering 3 to 6 months of living expenses, before you begin investing. Investing should be done with money that you don't need in the immediate future. Starting with a solid financial foundation will set you up for success and reduce the risk of needing to sell investments prematurely. Determine your risk tolerance. How much risk are you willing to take in exchange for potential reward? Your risk tolerance is a measure of how much volatility you're willing to endure in your investments. If you're new to investing, it's important to assess your comfort level with market fluctuations. Some investments, like stocks, carry more risk, while others, like bonds, are considered safer but offer lower returns. Understanding your risk tolerance will help you choose investments that align with your comfort level and long-term financial goals. Choose the right investment account. What type of account should you open to get started? Before you can begin investing, you need to choose the right investment account. For beginners, the most common types of accounts include brokerage accounts. These are standard accounts where you can buy and sell stocks, bonds, and ETFs. Retirement accounts, such as 401s or IRAs, which offer tax benefits and are designed for long-term retirement savings. Consider your financial goals and time horizon when choosing an account. If you're investing for retirement, a retirement account may be your best option. If you're looking for more flexibility, a brokerage account might suit you better. Select a brokerage platform. Which platform is right for your investment goals? Choosing the right brokerage platform is a critical decision for beginners. There are many options available, and each one has its own set of features, fees, and investment options. Some brokerages offer commission-free trading, while others may charge fees or have minimum deposit requirements. Look for a platform that offers a user-friendly interface, low fees, educational resources, and access to a wide range of investment options. Popular platforms like Robinhood, E-Trade, and TD Ameritrade provide great starting points for beginners. Fund your account. How much should you invest initially, and how often should you contribute? Once you've chosen your brokerage and opened your account, it's time to fund it. Many beginners start with a small amount and gradually increase their contributions as they gain confidence. You don't need a lot of money to begin investing, but the more you contribute regularly, the greater your potential for wealth accumulation over time. Consider setting up automatic contributions to your account, making it easier to invest consistently. Regularly funding your account can take advantage of dollar-cost averaging, a strategy that minimizes the impact of market volatility by spreading out your purchases over time. Develop an investment strategy. What if having a plan could increase your chances of success? Investing without a clear strategy is like navigating a maze without a map. To succeed, you need a well-thought-out plan that aligns with your financial goals. Your strategy should define your investment horizon, risk tolerance, and asset allocation. Consider whether you want to focus on growth stocks, value stocks, or dividend-paying stocks. Do you want to be an active investor who picks individual stocks or a passive investor who buys index funds? Defining your strategy early on will give you the clarity and confidence needed to make informed investment decisions. Diversify your portfolio. Why is spreading your investments across different assets the key to minimizing risk? Diversification is a powerful strategy to reduce risk in your investment portfolio. Instead of putting all your money into one stock or sector, diversifying means spreading your investments across different asset classes, industries, and geographic regions. This helps protect your portfolio from the volatility of any single investment. For example, if one stock or sector experiences a downturn, the other parts of your portfolio may still perform well, balancing out your overall risk. A diversified portfolio is essential for managing risk while aiming for steady growth over time. Start with low-cost index funds. Could index funds be your ticket to stress-free investing? Index funds are often the go-to choice for beginners due to their simplicity, low cost, and diversification. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, like the S&P 500. By investing in an index fund, you gain exposure to a wide range of companies across various industries, reducing your risk while still participating in the stock market's potential growth. Index funds are a great way for beginners to build a diversified portfolio without the need to pick individual stocks. Make your first investment. Are you ready to take the leap into the world of stock market investing? After all the research and preparation, it's time to make your first investment. While this can be a nerve-wracking step, it's essential to start small and gradually build your portfolio. Choose a stock, bond, or fund that aligns with your risk tolerance and goals. Remember, you don't have to be an expert to make a good investment. Start with companies you believe in or funds that offer broad market exposure, such as index funds. The most important thing is to get started, because time in the market is a key ingredient for long-term wealth building. Monitor and rebalance your portfolio. What if small adjustments can lead to big financial gains? Once you've built your investment portfolio, it's important to keep an eye on it. Over time, the value of your investments will change, and you may need to rebalance your portfolio to ensure it aligns with your goals and risk tolerance. Rebalancing involves adjusting your asset allocation by buying or selling investments to maintain your desired balance. This helps you stay on track toward achieving your financial goals while managing risk. By monitoring your portfolio regularly and making the necessary adjustments, you can optimize your chances for long-term success. Consider professional advice. Is hiring a financial advisor the secret to making smarter investment choices? When you're just starting, it's easy to feel overwhelmed by the sheer volume of information out there. How do you know what investments to choose? What if you're unsure about your strategy? Consulting with a professional financial advisor can help alleviate these concerns. A financial advisor can tailor an investment strategy to your specific goals, risk tolerance, and time horizon. They offer personalized advice, ensuring that you're making the right decisions for your financial future. Professional advice can be invaluable when navigating the stock market, especially as a beginner. So what do you think? Which step caught your eye the most? Drop your thoughts below, and don't forget to like and share, and also subscribe to watch more tips on making money in the digital age.